Welcome back to Pro News Weekly. This week, governments are stepping into the markets, and it's shaking things up.
No question about it. The US dollar has plummeted, the S&P 500 is shrugging off yields, gold is back to $4,500, and Bitcoin has broken out of its range.
Lots to get through. Let's start with the dollar.
So the dollar fell as Treasury bond yields dropped sharply. The Treasury Department signaled it wants to resist rising yields and increase the minimum threshold for buying back long-term treasuries to $4 billion. That has put the spotlight on the Treasury itself. Investors are now forgetting both the hawkish FOMC minutes and the Brent rally that the Middle East conflict set off.
But there's a limit to what the Treasury can actually do here, isn't there?
There is. That $4 billion is a drop in the ocean next to the $31 trillion of government debt. The risk is that the Treasury ends up on the same path as the Japanese government. It will be expected to step in every time yields rise, and that could leave the dollar behaving a lot like the yen.
On to equities. The S&P 500 reacted calmly to the slump in Treasury yields. This suggests that the market is being driven by factors other than worries about rising borrowing costs. Despite the rally in long-term yields, the index is up more than 12% since the start of the year and is within touching distance of record highs.
And fund managers are leaning in hard, aren't they?
Very hard. A Bank of America survey of asset managers shows 56% are overweight equities, the highest since November 2021. And cash levels have dropped to a rock bottom 3.5%. The market is undeterred by concerns about the U.S. economy, the Fed's plan to raise rates, or heavy spending on artificial intelligence. This really looks like a fear of missing out.
Let's move on to gold, which climbed back above $4,500 for the first time since early June. Falling Treasury yields and a weaker dollar did the work. It couldn't hold that level on the first attempt. But the favorable backdrop should inspire the bulls to have another go.
And there's a bigger theme running underneath this, isn't there?
There is. Investors keep getting fresh evidence that governments want to influence financial assets by non-market means. Following the coordinated currency intervention by the US and Japan, the US Treasury has now entered the government debt market. Moves like that chip away at confidence in fiat currencies and lift demand for gold.
Over to Bitcoin. That same government intervention has become one of the drivers behind its breakout from the $62,000 to $67,000 range. When governments try to control markets, interest in decentralized finance tends to grow. It helps that, at a meeting with the crypto industry, Donald Trump urged Congress to pass the Clarity Act as quickly as possible.
And the flows are backing up the breakout.
They are. Bitcoin is being supported by reports of a $1 billion inflow into exchange-traded funds between the 17th and 19th of August, after the previous week saw an outflow of $390 million. And the big holders, the so-called crypto whales, have bought $2.75 billion worth of tokens over the past 60 days. So what's the main event next week?
In the final full week of August, all eyes are on the traditional gathering of central bank governors at Jackson Hole. Investors will be listening closely to Kevin Warsh explain his view that the markets can do the Fed's job for it, especially in light of the Treasury's interventions in the debt market.
Anything else on the calendar?
Yes, the key releases are the U.S. Personal Consumption Expenditures Price Index, durable goods orders, Australian inflation, and Canadian GDP.
That's it for this episode. Stay on top of global market moves with Pro News Weekly.
Like, share, and subscribe, and we'll see you next week.